This is Warren Buffett, the greatest investor of all time. And this is his investment criteria, which will be revealed to you one by one in this video. And don't worry, you're not just gonna learn what Warren Buffett criteria is, but you're gonna learn how it is that you can apply his principles so that you can use them for your own investing. At number one, we have investing in businesses that you really understand.
Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. There can be all kinds of companies that have wonderful futures, but I don't know which ones they are.
The first one is that you understand the business itself. And what this really means is that you understand the business model. There are different kinds of business models out there. So for example, right now, subscription services like Spotify or Netflix are really popular, but there's other kinds of business models such as just simply selling products and services for a single price. What really matters here is that you understand how the company generates money and profits. The second aspect is really understanding the product or service that the company offers. So for example, let's say that you're investing in Microsoft, and for Microsoft, one of their biggest products is Office 365. Here, not only is it helpful that you understand how to use their suite of products, but also understanding that, for example, for organizations that rely on Excel to store company information, it is very hard for them in the future to be able to switch back to another data solution. And the last thing that you really want to look at is the competition. And the main thing that you want to look at there is how does the company compare to the competition? Does the company specialize in high volume, low cost production, or do they specialize in the opposite side of the market, which would be the high-end products? The second key criteria is the company's management team.
Well, I think you judge management by two yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it. Then you simply want to look at how well they have been doing in playing the hand, essentially, that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile. It's a little hard to pick out where they do fall, but I think you can usually figure out. I mean, it is not hard to figure out that, say, Bill Gates or Tom Murphy, Don Keogh, or people like that are really outstanding managers, and it's not hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders too. The two often go hand in hand.
This can be broken down into integrity, competence, alignment of interest, and capital allocation. Now, when it comes to the competence side, Warren Buffett really looks at the experience that the manager has had in the past, as well as what their current vision is for the company and their plans that they're integrating into the company. For the capital allocation, Warren Buffett really looks at whether the management decides to reinvest profits back into the business to generate more revenue or to distribute those profits to the shareholders. The third criteria is the company's earning power. In simple terms, this means, does the company have the ability to grow revenue and profits in the future, or is it likely to actually decrease the revenue and the profits that it generates? And of course, Warren Buffett prefers to invest in the businesses that are likely to grow in the future, such as Apple, American Express, Coca-Cola, etc. The last key criteria is the valuation.
If you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything.
As you heard, even if the company is the perfect fit, but it's just selling at too high of a price, it's just not worth investing in it. But what Warren Buffett does extremely well is that when that happens, he just patiently waits until the stock price drops, and right away he gets on it and takes a big position in that company. Now, the thing about Warren Buffett is that he's managing huge sums of money for a lot of people, but that also has some drawbacks and certain areas of opportunity for you as an individual investor. So let's let him explain this.
If I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951, but from the end of 1950 through the next 10 years, actually returns averaged about 50% a year, and I think they were 37 points better than the Dow per year, something like that. But that I was working with a tiny amount of money, and so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that were just ridiculous. They were ridiculously cheap, and obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it at that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically.
As you heard, Warren Buffett is managing so much money that he can't take advantage of certain opportunities. So for example, he can only invest in companies that have huge market capitalizations. But you as an individual investor have every single opportunity to do that and even make greater returns than he can. For this, there are very powerful tools like white sheets that can help you find great companies to invest in by, for example, speeding up your valuation process, or being able to compare companies very quickly like this. I hope you enjoyed this video. If you did, make sure to subscribe to the channel, and I'll see you in the next one.